Our next session addresses a question every serious investor grapples with. How do you build meaningful wealth when returns are becoming increasingly competitive? And this makes me wonder, is the easy decade behind us, or do we go further out on the risk curve? Leading this conversation once again is Kshitij Anand, editor, Markets ET Digital. And joining him is someone who has built one of India's most admired investment businesses, and along the way has inspired an entire generation of investors, present company included. Please welcome Radhika Gupta, Managing Director and Chief Executive Officer, Edelweiss Mutual Fund.
Thank you so much, Rahul, for introducing us. And yes, the topic is very interesting, Radhika, I'm sure. Because while I'm sure a lot of people who've read the topic or which is displayed on the board, you're thinking that it's more of a headline gimmick that probably it is doing. But yes, this is very much possible, and that is where we'll try and bring the conviction to. And probably not chasing multi-baggers, but it's all about disciplined investing. That is more of the theme of the day that we're trying to get out from Radhika, who's been a brilliant fund manager. And you could say she's a big motivator as well. That's what I myself also is one who's influenced from Radhika. So Radhika, thank you so much for joining me in this discussion.
Thank you.
Great.
I'm told you're going to ask me tremendously tough questions, so I'm all prepared.
Absolutely. Well, the topic is like that. And if I'm not able to ask, then I'm sure some of you in the audience would be able to do something like that. But, coming to the basic question, is it really possible?
So is it really possible? 100 crores in a 10 to 12% return environment is the question. So the answer is yes, but, let me break it down a little bit. Firstly, when the question is framed this way, we look at 10 to 12% return environment as if it's some aberration that has happened, that हमारे साथ कुछ बहुत गलत होने वाला है. But I think if you step back and look at history, 10 to 12% was always the return environment. It's just that the last 5 years have misled us, right? And if you look at the long-term returns of the Nifty index, they are about 11 to 12%. The nominal GDP growth of India has been in the 10 to 12% range. So 10 to 12% is not living in terrible times. I think, of course, we live in an era where social media has glamorized money making to be a lot more short-term and focused on a single stock pick, a single call on Korea, a single startup investment that is gone right. I almost say we've equated it to first crush or pehla nasha, when, really building 100 crore portfolio is a lot more like boring marriage in that sense. Now, if you look at 10 to 12% return, and I'm again going to go back to this number, and if you look at some of the smartest, and there's some very smart people in this room, some of the smartest allocators of capital in the world, family offices, institutional endowments, what do they target for their portfolios? They say usually inflation plus 4 to 5%. Most of them don't wake up saying, I wish for a 25% return. And what they want to make sure is that they can earn this return in a way that is reasonably risk adjusted, that meets their needs for liquidity, and this journey of compounding is not interrupted. In the Indian context, if you believe inflation is 6% and you layer on 4 to 5%, I think an 11 to 12% portfolio return target is outstanding. And by the way, that means that you're doubling money. So to come to your 100 crore question, it means you're doubling money every 6 years. A 1 crore investor over 25 years will already hit 15, 16 crores at 10 to 12%. And then you assume there will be elements of top-ups, growth, income growth, etc. And the short answer, yes, it's doable.
Absolutely. And great that you brought out the point that as your income grows, the money that you're allocating towards your fund should also grow. So that's where the element of STP comes in, and that's also an important element wherein we also put in more money for it to compound on an annual basis. I think, when we say 10-12%, but in reality, in our heart is always the multi-bagger or something which can actually, double in 6 months. That's what's running in our heart, but in reality, always it's the 12%. On an average, you could say that that's where. So yes, how important is STP?
So let me tell you a story. I was sitting in a session like this with mostly young investors.
Absolutely.
And a 17-year-old guy asked me a question from the audience, and he said, if I am 17, what's the best piece of investment advice that you can give me? And I told him, and me and another mutual fund CEO were on that panel, and I said, don't focus on anything I'm saying and don't focus on anything he's saying, because at 17, you actually don't have capital. You're in the business of earning capital. And as a young Indian, your biggest asset is actually not your financial capital, it is your human capital. And in this journey of 100 crores and compounding, we often forget that, at least I believe, human capital compounds far faster than financial capital. If I look at myself, and I'm not particularly young, I don't need to divulge age, but somewhere halfway through my life, as I look at my portfolio, I still believe that I have active income that I'm going to create because of the value I create in my job, and I have passive income I'm going to create in my portfolio. I still believe today active income will far outweigh passive income. Sure. The other thing I've learned, and this is coming to your point on top-ups and STP and all of that, right, is that every year, and this is an exercise that my husband and I do consciously for our own portfolios, we often don't reset our investment approach with changes in income. So one of the things that we actually do now every year at the end of May, when our own numbers change and we have a financial picture for the year, is we rebudget our whole year. We end up increasing our SIPs usually by 10 to 12% a year, because most of us actually sitting in the audience have increments, have higher business income, whatever it is. And I think that is very important. And regular investor who's increasing the amount they are investing by 10% every year is going to do materially better than that 15 to 16 crore outcome.
Absolutely valid advice there. And so probably in this environment, and Mr. Naren said that yes, we are in a boring market, but at the same time, it's the best time to invest at this point in time. But from the investor perspective, how should investors rethink asset allocation at this point in time?
So I think asset allocation has always been important, and I think asset allocation is talked about in these times, but it's important even in the heady times. Again, just because I've been doing a bit of personal portfolio analysis and I haven't shared this, when I looked at my own portfolio over the past 5 years, I actually did an attribution as to how much of the returns are coming from asset allocation and how much are coming from fund selection, because we're always obsessed. Should I buy this fund? Should I do that fund? Fund selection occupies a lot of the energy. 59%, and I did this precisely, of the returns were coming from asset allocation. 31% was coming from 41% was coming from whatever genius of fund selection that I was doing. So that, I think, tells you that it is the primary decision that you need to take. Now, I think our approach to asset allocation has always been return maximization. Absolutely. In an environment like this, I think you need to think about constructing portfolios and asking, if everything is not cheap, if everything is not expensive, what risk am I taking to earn that return, and can I do this a little more efficiently? I have a small framework that may be helpful, and I think there are, I call it BAT, B-A-T. There are 3 things we're trying to seek from portfolios. One is beta. Beta is the return that markets will give you. It could be equity beta, it could be fixed income beta, it could be commodity beta, right? The second is alpha, which is the outperformance over the benchmark, and we're sitting at the Alpha Summit, we all know. And the third is something I call tax and other efficiency parameters, which is, doing things in the most efficient way, because finally portfolio returns are after tax. Now, in a 20 to 25% return environment, beta came very easily. I remember someone talking about multi-asset funds and saying it's very easy to run a multi-asset funds because equities are doing well, gold is doing well, and fixed income is doing well. We are now moving to an environment where the beta component may not come as easily, and you may have to do a little bit of harder work on alpha, and you may have to be a little more cautious about efficiency.
Absolutely. In fact, post-COVID, there has been a one-way journey that most of the investors, especially the new age ones, have seen. And probably post that, now that we've entered this neutral phase, for the past 12 to 18 odd months, wherein market has not done a lot, where as compared to, let's say, the global markets, or relatively compared to other markets. But now that we talked about most of the young investors which have come to the party, that's what we've been also writing on the headlines. But yes, the D Street party. And especially, there's a lot of influence of social media that has also, you could say, to a certain extent, it has impacted the way how young investors have sort of joined D Street. So, is the story, can we say that it's more flowery story that most of the influencers are painting at this point in time?
Okay, so I get very scared of these questions, Kshitij. I don't want to be sounding like the 40-year-old auntie, which is what you get called when you're 40, who's sitting here and hating on young investors and social media, because I am not that. And those of you who know me know that I have been a big advocate of the use of social media in communication. So let me start with that disclaimer.
Absolutely, absolutely.
I'm an MF CEO, so I love disclaimers. So I'll tell you my take on it. And, a few days ago, I saw this picture of Roger Federer floating around. And there was a picture from, I think, 2007, which was really his peak playing period.
Yeah.
And, he was shirtless in that picture, and people were having a discussion about his body and how his physique looked. And quite frankly, his physique looked like a normal person's physique, and he wasn't muscled up, etc. And someone made a very appropriate comment that if you showed this physique to a social media influencer on fitness, he would tell you everything is wrong with Roger Federer, right? Because he's not beefed up, he's not had enough protein intake, whatever, I don't understand this category enough. But this is obviously someone who's won 80% of the matches he's played, consistently been a champion, he's Federer, etc. So I think what social media has done is compressed time horizons. It wants you to have a genius body after 3 days of going to the gym, not realizing that perhaps a sporting career is 20 years of playing and discipline, etc. So it's condensed the time horizons. I also think it's an ecosystem that rewards extremes. I joke, there's a colloquial saying in UP where I come from that India is a very dramatic country, and या तो हम लोग रेल में रहते हैं या हम लोग जेल में रहते हैं. And I think social media is an exaggerated version of that. So in the best of days, the commentary will be dump all your FDs and buy crypto, and in the worst of days, the commentary will be negative 2-year SIP returns are not beating FD. And I think investing is really about sitting in the middle. I also think that in general on social media, we tend to glamorize a lot of outcomes. Someone's doubled money in 3 years, etc. But we don't have the context behind that. We don't know if that outcome has come because of leverage. We don't know if that outcome has come because of inherited wealth. You don't see the failures. You don't see the drama behind that outcome. And I genuinely believe India is an extremely dramatic country. Rashesh once perhaps told me the best India investing analogy, which is that investing in India is like walking on a road, and at the end of the road, if you have a 25-year horizon, there is a pot of gold. There is a 100 crore portfolio, there is a pot of gold. But like every road in Mumbai, the short term and the road is always under construction, and it is full of potholes. And every quarter there is some kind of crisis. So social media tends to exaggerate crisis, and it makes it harder to take the long road.
You painted the picture perfectly, Radhika, and very well said. I'm sure a lot of us will take cue of that. In the meantime, there's another asset class which has become really popular. It was popular with women, that was gold, and now it is getting popular with investors as well. So yeah, so what role is gold and fixed income and alternatives will play, let's say in the next 5 years or so?
So I think 3-4 asset classes here: gold, fixed income, alternatives. Maybe I'll take the luxury to add
Absolutely, yes.
international funds
Sure,
also.
sure.
So I think a lot has been spoken about gold. Naren spoke about gold and silver extensively. So I'm not going to repeat that. I think gold and silver, to a smaller extent, play the role of a diversifier in your portfolio. It is a little bit like buying home insurance. Now, if I told you that you should buy home insurance, you would buy home insurance. But if I told you that the home insurance in your portfolio is larger than the value of your house, you would say this doesn't make any kind of sense. So some allocation to gold and silver, it could be 10%, it could be 15%. I reckon it should not be 15%. See, gold is finally a commodity. And there are two parts of gold. There's gold for gold prices, and then there's the benefit you get of currency depreciation. Let's leave that aside. Commodities don't have a structural reason to go up. So are they fundamentally wealth creating asset classes? No. Are they diversifying asset classes for when things go wrong? That, and I think leave it at that. The second one you asked me was about real estate.
The luxury real estate, because that's what's getting popular nowadays.
I get into
making the headlines, sorry.
I get into trouble with my views on real estate, but I will still give them. So I believe primary homes are not real estate, so I'm going to put that aside because they are bought for emotional reasons. Finally, you can't live in a mutual fund. As much as I love mutual funds, you can't live in a mutual fund. And I do think real estate is highly location and asset specific. But in general, my view is investors don't do a fair financial comparison of real estate outcomes versus financial assets. And I generally believe, I don't like illiquid assets in my portfolio. I believe that if someone is making me lock up my money for 3, 4, 5 years, that is a lot of risk I'm taking. So I must get something seriously more than I can get in an equivalent liquid asset. It goes back again to my back framework that if I am giving up the efficiency of liquidity, what am I getting in return? And when I typically look at real estate portfolios, net of liquidity discount, I don't see that. The two other asset classes that you mentioned, I'll quickly cover. Sure. So global investing is currently theme. I'll tell you, I grew up abroad. I lived 25 years of my life abroad. And when I came back to India in 2009, I started investing in 2011. The first thing I did, and I don't think anyone was talking about global funds in 2011, the first thing I did was look for a global fund as an Indian rupee investor. I had nothing to do with the mutual fund industry, but I went hunting for a global fund. I can tell you the fund I invested in. It was an Aditya Birla International Equity Fund because it was one of the 3 funds available. Because I had a very strong conviction that as much as I love home, there are just some themes that are not present in home country. We are seeing some of them now, but that has been present for time immemorial. And there are different economies that do well at different points in time. So I have always been an advocate of having some US and some emerging markets exposure in a portfolio. How much, it's for people to decide. My only wish is that it is not cyclical. And it's not done because the last year's return has been 60-70%. I run one of the largest baskets of global funds in India, so I have seen the whole story with China and lots of ups and downs. Happy to talk about that in the Q&A. The last one which you mentioned is alternatives. Again, I think they should serve a need in your portfolio. One particular, if it's a mutual fund packaged as an alternative, then it is alpha and beta with less tax efficiency. So I don't like that. But I don't think the whole unlisted space is very, very interesting. I think a lot of alpha and value today in certain sectors is captured before countries hit the listed market. And if you do have the ability to do it, and you have the sanity around valuations, I think unlisted can be a very interesting part of the portfolio. I've gone to becoming a 20% unlisted investor over the last few years in post-Shark Tank, and I think it's been incredibly rewarding.
Absolutely. 20%, that's a big number. Unlisted. Okay, that's for the headline, right?
That's not, I can't do listed. I've never owned a stock in my life. So the only direct things I can do are unlisted. And, it's a lot of fun hanging out with some of these entrepreneurs.
Perfect, perfect. Now, we've talked about most of the asset classes. We talked about equity, fixed income, real estate, global investing, alternatives. And, well, there's another thing which is coming up, SIFs. Now, a lot of sophisticated investors have already ventured into the fund. How will that play a role in the next few years' times?
So I'm the biggest SIF bull that you're going to see. We are also, as we presently speak, the largest SIF manager in the country. But let's step back a little bit from that. I think Naren showed a slide, and I would build on that in the previous session. And there is a difference between product and need. And I think as consumers in HNIs, we are very focused on product. We should be focused on needs. SIFs or all financial products will succeed if they meet a unique need that other products in the market are not able to do. Everything else, long, short, derivatives, this, that, flexibility is all engineering. Finally, when you look at a car, you ask, is it giving me luxury? Is it giving me mileage, right? Exactly. What is the need? So I think SIFs have tremendous flexibility. And again, if you go back to my BAT framework, beta, alpha, and tax efficiency. SIFs will give you less beta. So their reliance on earning returns from gold doing well, from equity doing well, from rates falling is going to be less. They'll have higher contribution that comes from alpha if they know what they're doing. And because of the way SEBI structured the platform, they are extremely tax efficient. So if used right, they can be very powerful. I'll give you a use case from our own live experience. I think one of the common parts of an asset allocation is fixed income. But in the last 2-3 years, since we have had the taxation change on fixed income, nobody in this room, including me, wants to buy fixed income either in the form of FDs or in the form of debt mutual funds. But is the need, the consumer need for yield, for tax efficient income there? It absolutely is there. So with the first SIF that we did from our brand Altiva, we tried to create a use case that can you do 9 to 10% on a pre-tax basis with capital gains efficiency so that a consumer who's seeking an 18 to 24 month kind of low market linked, high absolute return investment gets an outcome. Honestly, it probably will be the fastest fund to hit 5,000 crores in anything that I have launched. So that tells you that if you meet a need correctly, then there is demand for it. Trade secret. We've launched this 6-7 months ago, and till now I had not been an investor in the fund outside of my mandatory investments. But something suddenly happened where I realized that in my portfolio, I need something for 2 years where I don't want to take equity market risk. Guess what I did? I picked up the SIF. So I think SIFs will solve for powerful needs and can be a very significant part of the portfolio, especially in a low return world.
Absolutely. Now, we've talked about wealth creation, and there's another factor which really supports wealth creation, and that is economy. And because we are in this environment, especially in the past 12 months or so, we've been seeing geopolitical concerns. We are seeing tariff tantrums. We are seeing a lot of other things which are really impacting the economy and the balance sheet of most of the India Inc. Oil shocks just came in, but yes, it's still a shock. Probably the situation could continue for some more time. We can't really foretell as to when it will end, but yes, it will keep on impacting the economy. But how are you seeing the whole thing, panning in the next few years' times?
So whenever I look at India as an observer, I try to have two views on it. One has to be a short-term or a medium-term view because we manage immediate money. But one also has to be a slightly medium-term.
The more pessimist one, optimist one, sorry.
It has to be. I mean, it doesn't have to be optimistic or pessimistic, but it has to be realistic. And maybe I'll start with the second and we can talk about the first.
Sure.
If I look at the Indian economy, I think in bad cases we grow at 6%. In good cases we try and grow at 8%. So we are a 6 to 8% growth economy. That means a 10 to 12% nominal growth economy. I still think that makes us one of the faster growing major economies in the world. So that story doesn't go away for me. What continues to work for us as an observer? I think demographics continue to work for us. I think reforms continue to work for us. I think financialization continues to work for us. And I think if there is a single factor that I had to be a bull on, it would be Indian entrepreneurship. I don't know if you remember, but about a month ago, Mike Milken, who runs the Milken Institute, made this comment that if I took an S&P 500 company and replaced an American CEO with an Indian CEO, I would be more optimistic about the company.
Okay.
And then a young group of kids actually backtested that assumption and found out that the result would actually generate alpha over the S&P 500. Now, may not be a serious investing strategy,
Right.
but it tells you that India as management has got something right. India as entrepreneurs, whether here or abroad, has got something right. There's a lot of work we have to do. If I had to be a bear, I would say we don't invest enough in R&D. We haven't built a single global brand, global consumer brand.
Sure.
But I hope we'll get some of these things right. And I think a 10 to 12% growth market, where a lot of geopolitical risks have been factored in. You've seen the worst of crude at 100 plus, tariff tantrums, and valuations coming down to more moderate levels may not be a bad bet. A 10 to 12% growth market at 35 PE, I would be less excited about.
Absolutely. So going forward, what structural trends could define the next decade, according to you, for wealth creation?
So I'm hoping the character of Indian companies will change. The last few decades were a lot about things moving from the unorganized sector to the organized sector, benefits of digitization. Some of that were some of the themes that were driving the economy. I hope that as we look to the next 10 years, we will see more global companies, companies that are investing in R&D, companies that are actually going out there and becoming global brands.
Something which was a miss earlier.
Yeah, I mean, I always say that, you know, if you go to Japan and walk down Ginza Street, you will see a global brand in everything from Shiseido, which is a makeup company, to Yakult, to Royce, to forget all the majors in electronics. And if you look at Korea, you'll see the same. But if you look at Thailand, you can't name a decent global brand. So I think that should be a theme that will change. You know, sectors one can also go through, but I think quickly at the top of my head, if I were to look at three themes that would excite us, one is the whole space around financialization of savings. You know, I am a part of that industry, but I do believe financialization is just getting started, and the whole ecosystem around asset, wealth, capital markets will continue to be very exciting. I think India's energy and defense needs are only going to grow. Everybody is going to spend more on defense, everyone's going to indigenize defense, and our power needs are going to go up. And the third one is a movement from consumption from basic to discretionary and premium. I was looking up an interesting stat. If you go to the US, they have 15 hotel rooms for every 1,000 people. China is about 3 or 4, I think. India is 0.2. There's a similar story with hospital beds. So again, the US probably has about 3 hospital beds for 1,000 people. China has 4 or 5. India has 0.4 or 0.5. And our needs, whether from our tourism, from our hospital, and then there's this whole thing emerging. You know, there was a Coldplay concert in Ahmedabad. Do you know how much revenue that generated? 600 odd crores. So young Indians are also increasingly moving towards an experience economy. So I think all the individual elements of premium consumption will surprise us.
Absolutely. Good that you brought the Coldplay concert, because if I remember, the tickets just, it got booked in less than 10 minutes or half an hour, something like that. It was a record time when the tickets were all booked.
And what's interesting is that for every 100 rupees spent on tickets, 500 rupees were spent on the ecosystem, right? So I was traveling to Ahmedabad around the time of the Coldplay concert for work, and the ITC Narmada was costing me 1 lakh a night, which I didn't stay at. But finally, it's Ahmedabad, yeah, it's not Maldives.
Right. Okay. So I think we have. Okay, I have few questions, but I would rather request some of the audience to probably ask a few questions, if that's all right.
Absolutely.
All right. So even though I have a couple of questions, but I will give that time to the audience. Anyone? Okay, I see few hands.
I see lots of hands, huh?
Yeah, that's also. Radhika, you want to take a pick?
Yeah? No, you choose. You choose. Anyone at the back.
Okay.
Anyone at the back, because it means people at the back were listening, so that's good.
Right. Sure. So
You can pass the mics.
you can pass the mic. There's a few hands there.
Yeah, all the hands at the back, we can do that.
Okay, you want to ask a question, ma'am?
Yes.
Okay. The format would be, what's your name first, and the
Hi,
question.
Radhika. This is Pallavi.
Hi.
My question to you is, suppose you were to allocate a 100 crore portfolio for an investor today, what would your advice be for India versus sending some money outside India? Because given the rupee depreciation, we see a lot of concern where investors feel like, should I invest some money in the US also? Also, particularly, there's a lot of FOMO given the AI theme playing out, and in India, there aren't many opportunities to play that.
Okay.
Couple of questions in one.
Yeah, I'll try and keep answers short so I can take more questions. But I would never make this decision based on today's context and out of FOMO, because you make bad decisions. I would make this decision with a 10-year horizon, and I would try to think about this structurally. Now, if I look at just your equity component of the portfolio and how much fixed income you have and all of that, you should sit and decide based on your goals. I think for a starter Indian investor, having 15 to 20% abroad today is a very, very logical thing to do. You will build this with your comfort. It could be 5, it could be 10, it could be 15. Keep in mind today is a little bit of a tricky environment because many global fund options are closed, but many of us are building them out. Now, which economies would I allocate to? Well, structurally, the US is about 65% of the world's market cap. So if I were to allocate 15 to 20% globally, the US would probably occupy 10. You could choose whether it is a broad-based US opportunity, it is a more tech-focused US opportunity, that I would leave to you. I think the second largest economy in the world is China. Where I would park the next 4-5% of allocation. And this to me is your international core portfolio. Everything above and beyond that is satellite. And to the point Naren made, there are always going to be markets that are up 60-70% in a year because a particular company has done well. I would try and control that FOMO. Focus on the 15% core allocation that you have to the major markets.
So Taiwan being one of them, which we are seeing just sporadic rise.
Yeah, Taiwan being one of them, Korea being the other one of them. And I always generally prefer broad-based funds. So even if you have to do that, do an emerging markets fund. That will cover China, Korea, Taiwan.
Absolutely. I hope that answers your question.
Thank you.
Right. So we have any other? So we have this one gentleman here as well, in the first seat. First, we will take this question.
Hi, so I just had one question.
Your name, sir?
Oh, Jay. So,
Jay, hi. How are you?
I'm good, how are you?
Good. Yes.
One question is that
CJ.
Indian companies don't spend a lot of money on R&D and CapEx. So that's a fundamental problem coming up in the next decade that I see. And if you just look at Samsung, their net profit is equal to what the top 4 or 5 companies that in India. So how, because at the end of the day, it's what investment companies give companies money. So Google just raised $80 billion even though they had cash reserves. But in India, it's really hard for companies to raise money. How would you solve that problem?
I think we need and I've been a critic of this, okay? I think we need so is the problem real? I think the problem is real. If you look at India.
In fact, we discussed this in the conversation as well, yes.
Yeah. If you look at India's R&D spending as a percentage of GDP, it's one of the lowest in the world. And if you look at us historically, when companies have had surplus capital in India, has been talking about raising money. Historically, we've preferred to do a dividend or buyback because we are very, very ROE conscious and we like to favor the stock market. And perhaps it is because we grew up in an environment of scarcity and uncertainty. So, I don't want to blame the past for the context. I do hope that Indian companies, and I do believe, they will have to be different. And by the way, when we talk to a lot of corporates, in some part of corporate India, you are seeing the change in R&D spend. And I think it is necessary. I would say one more thing. Who drives this behavior? We drive this behavior as investors, right? Companies do what investors reward. So in China, the market rewards scale. Here we as a market reward ROE. So maybe a lot of us as investors also have to look a little beyond and not think quarter to quarter.
Actually, some of it got highlighted after the AI thing came in, for the past 12 to 18 odd months. And
I think in IT it got very, very sharply highlighted.
But then it sort of now transited to other industries as well as to, yes, we have to spend towards R&D, creating new systems, creating new technology so that the world can actually, take forward. Also, we have a quick 30-second question. Anyone?
Excuse me?
Yeah.
Hello?
Who's?
Here.
Okay, back in the last, this gentleman? Okay.
You are deciding who asks the question.
Sure.
Hi, Radhika.
Sure, no worries.
Hi.
Your name?
Aryan Awasthi here from Ibhaveda. You touched upon unlisted investments and angel investments. I just wanted to ask, right now it's very relationship oriented, network driven. Do you see technology sort of democratizing that space, making it more data driven, like how markets are now?
So, yes and no. I think there are a few exchanges that are coming up to tokenize kind of unlisted shares and give access to that. But finally, for all the glamour here, these are unlisted companies that are very, very small in scale. Just the quality of data, by the way, as a little bit of an angel investor, is extremely patchy. So, and that is the nature of the company. When a founder is in year 1 or year 2 or year 3 building the company, I don't expect them to have perfect MIS. I expect them to focus on product market fit. So I think there is going to be a fundamental difference between the unlisted and listed universe. There will be funds, there will be fractional units that will be available. But this is never something I think that should become, the food of the retail investor. I've been very against what happened even on the SME IPO platform where, companies with one single Yamaha plant, etc., were pricing on price to dream ratio. So I think there is a stage of evolution for these companies and a kind of investor that they need. Because many of them are zero. Many of my outcomes are also zero, by the way, in these companies.
Being candid there, Radhika. Well, on that note, thank you so much for the time. And you've been a lovely audience as well. Please give a big round of applause to Radhika.
Thank you, guys.